Good day and welcome to Hindustan Foods Limited Q3 and 9-month FY2024 earnings conference call. This conference call may contain certain forward-looking statements about the company which are based on belief, opinion and expectations of the company as on the date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Kothari, Managing Director, Hindustan Foods Limited. Thank you, and over to you, sir.
Thank you, Yusuf. Good afternoon and welcome everyone for our 9-monthly and third quarter earnings conference call. I'm joined on the call by Ganesh Argekar, our Executive Director, Mr. Mayank Samdani, Group CFO, Mr. Bankim Purohit, our Company Secretary, and SGA, our Investor Relations Advisor. I hope everyone has had a chance to go through our updated earnings presentation, which was uploaded on the stock exchange and our company website. Coming to the specifics, we believe that our business model with a diversified product and customer base has helped us weather the headwinds in the overall consumer market of the last year or so. The investments done by the company over the years have given us a strong foundation. In this regard, I would like to highlight that in the last 5 years, our gross block has grown fivefold to more than 1,000 crores. This has been done on the back of both greenfield expansion as well as M&A. This strong foundation is now enabling us to plan for new investments that will set tone for the future growth over the next few years. In addition to the continued investments in the FMCG business, like our new ice cream plant in Haryana, the new beverage plant in Assam, and a few others that we are working on, we've also been working on opening up adjacent sectors where we think we can grow. One of these sectors is OTC pharma and healthcare products, in which the company had identified certain M&A opportunities. I'm happy to report that in this quarter that went by, we finally closed the Baddi transaction, which had been held up for statutory permissions for more than 3 quarters. I expect this factory to be completely integrated within the next 3 to 6 months, and we are optimistic about being able to offer a new range of OTC pharma and healthcare products to our customers. The other sector that we've been bullish about has been the sports shoe category, where we are seeing some tailwinds due to the government policies and global trade movements. To leverage this, we again have decided to go the route of inorganic growth and have identified some M&A opportunities which should help us scale this business sooner. We do strongly believe that these new sectors, along with the huge potential of our mainstay FMCG market, we should be able to deliver supernormal growth for the immediate foreseeable future. And in order to fund this growth, the company has successfully concluded the preferential issue of warrants to the tune of rupees 400 crores in the December of last year, which should give us enough capital to take HFL to the next level. I will now hand over the call to my colleague Ganesh Argekar, who will brief you about the operational highlights of the past quarter.
Thank you, Sameer. Good afternoon, everyone. I would now walk you through the operational and business highlights for 9 months and Q3 FY24. The December quarter is a seasonal low for 2 of our product categories, ice creams and beverages. In spite of this and in spite of the continuing pressure on volumes, all our factories performed well and delivered the highest ever quarterly turnover for the company. We are prepared for the onset of summer and are confident that we should be able to exceed this record in the coming months. The company, through its wholly owned subsidiary, KLS Shoetech Private Limited, has completed acquisition of sports shoe manufacturing unit located in Kundli, Haryana, and has also completed the acquisition of the Baddi unit manufacturing OTC pharma products. We are in the process of integrating the operations and welcome the nearly 1,000 people who will be a part of the HFL family as a result of this transaction. Additionally, we are working on the ERP integration and the vendor onboarding for nearly 5,000 new raw materials and packaging material due to these new operations. The board has also authorized the management to negotiate and enter into a BTA for the acquisition of another sports shoe manufacturing facility with an expected investment of around 100 crores. The factory being set up in Guwahati, Assam for the manufacture of juices is progressing well and is expected to start commercial production for Q4 FY24. This is well in time for the season, and depending on the weather gods, we are looking forward to a good ramp up in this factory and the one in Mysuru, which is manufacturing beverages. The Greenfield ice cream facility in Haryana is being set up with an expected capex of rupees 100 crores and is progressing well. The company has signed a contract with the Central Warehousing Corporation Kundli for the land and building. The company also expects to start partial production at the site by Q3 FY25 and a complete ramp up by Q4 FY25. With this, I now hand over the call to Mayank Samdani, our Group CFO, to take you through the financial results for the quarter ended 31st December 2023. Thank you.
Thank you, Ganesh. Good afternoon, everybody. I am pleased to highlight that we have achieved the full year PAT number of last year in the first 9 months of this financial year. With this, we are confident of closing the number at a record PAT. Specifically, revenue increased by 4% to 2,027 crores in 9 months FY24 from 1,941 crores in 9 months FY23. EBITDA grew by 29% to 164 crores in 9 months FY24 from rupees 127 crores in 9 months FY23. PAT increased by 38% to rupees 70 crores in 9 months FY24 from rupees 50 crores from 9 months FY23. Performance of Q3 to FY24. Coming to the quarter's performance, in spite of the seasonal effect that Ganesh referred to, we have posted the following numbers. Revenue increased by 8% Q-on-Q and 7% Y-on-Y to rupees 730 crores in Q3 FY24 from rupees 677 crores in Q2 FY24 and rupees 679 crores in Q3 FY23. EBITDA grew by 4% Q-on-Q and 29% Y-on-Y to rupees 58 crores from rupees 55 crores in Q2 FY24 and rupees 45 crores in Q3 FY23. PAT for the quarter increased 29% Y-on-Y from 17 crores in Q3 FY23 to rupees 22 crores in Q3 FY24. The numbers of this quarter were impacted by the integration of the new units, both Baddi and KNS Shootek. We believe that the financial number may be affected by this integration for one more quarter, and both the new acquisitions should start normalizing in Q1 FY25. Accordingly, we do believe that we are well on track to meet our guidance of achieving 4,000 crore plus top line by FY25. With this, I would like to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Nitish from Chris Capital. Please go ahead.
Hi, am I audible?
Yes, Nitish, please go ahead.
Yeah, so my question is on the comment made in the presentation and also in the opening remark. So can you quantify the impact coming from the integration of these new Baddi and KNS Shootek facility in this quarter, and what kind of impact we are assuming in the next quarter?
You mean the impact on the bottom line, right?
Yeah, on EBITDA margins also.
So we obviously can't, it won't affect the margins, but in terms of the quantification, we can give you a thumb rule of what is happening. You're talking of an investment of close to 125 crores in the Baddi facility. And we had 15 days of a period which was accrued in the previous quarter where revenues didn't happen. In terms of just capital servicing, which is depreciation and interest, we believe that the hit was close to around 3 crores of rupees. In addition to the fact that we also had to pay salaries for all the people for those 15 days. This will continue in this quarter as well to a certain extent because we are working on the transfer of the licenses. As you'll remember, this is a regulated site. It has a US FDA, MHRA, and a Russian FDA approval. It will take us some time. Our current estimate is between 3 to 6 months before we are able to normalize the operations completely in this factory. Now, as a margin, obviously, because we've mentioned it before as well, Nitish, that our revenue figures, it may not be the best way to look at us in terms of margin. So that's why I prefer giving you the absolute numbers in terms of the hit on Bati. As far as KNS Shootek is concerned, our calculation is that the hit in the previous quarter was just about 1 crore or so. Given that since then, in this quarter, we have announced the acquisition of one more facility, which is the manufacturing assets of a company called KNS Trading. And the board has authorized us to acquire one more facility, which is the third facility for the sports shoe manufacturing. We do believe that these integrations will continue to affect us again for at least one more quarter.
Got it. And how much headcount are we increasing through this? Through these two acquisitions?
So right now we have nearly 1,000 people who've joined us already. I don't have the details to give you about the BTA that we are currently discussing. As soon as I have some quantifiable details about it, I'll come back to you.
And how many of these would be from Bati?
How many of the workforce is from Bati?
Yeah.
Approximately 400.
Okay, got it. Thank you. That's all from my side.
Sure.
Thank you. Next question is from the line of Priyank Cheda from Vellum Capital. Please proceed.
Yeah. Hi. So my question is on the gross margins. We have seen a steady rise in the gross margin for now last 2 years, and that has been the phenomena every quarter. How should we see this progressing ahead? I'm sure the vinyl raw material prices would have helped. Are your customers in the discussion to reduce the prices? Would we see a further expansion into the gross margin given we get into a better utilization phase? So how should we view the gross margins for next 2 years? Keeping in mind there is a seasonality impact of beverages also.
Priyank, I'm going to split this answer into two. One is the normal answer that I would have given before the shoe acquisition, and one is the answer that I'll give you now with the shoe acquisition coming into picture. So before the shoe business came into picture, nearly 80 to 85% of our business is in a model where raw material and packing material costs are passed through completely. And as a result, we have time and again emphasized that you should probably not be looking at margins as a basis of the revenue. Just because of the deflation in case of the raw material, packing material prices, our margins are looking better. Frankly, the team, including me, have done nothing to improve that margin. It has just happened by the fact that there's been deflation in commodities. The flip side is also true. If you looked at our performance a year and a half ago, when inflation was at its peak, our margins were deteriorating, and again, our team was not to be blamed for it. That's just the way the model works. Now, after the shoe acquisition, and I'm talking about maybe a quarter from now, we will have a slightly larger say in terms of the gross margins for a couple of reasons. One, that there is a lot of shared manufacturing as far as the shoe business is concerned. And the shoe business functions in a completely different way. The shoe business will become sizable in the next, let's say, 6 months. And post that, I will come back to you with some kind of definite guidance in terms of gross margins.
So is it fair to say that, of course, a larger benefit will come after the shoe manufacturing business becomes larger, but then the shared manufacturing would have a slightly lower margin versus a pass-through model of X of shoe model?
So even in case of the shared manufacturing, Priyank, where it is, again, there, most of the raw material, packing material costs are a pass-through, right? Only in case of the private label business do we absorb or do we take the risk of the changes in prices of raw material and packing material. Otherwise, predominantly our model before the shoe business was that entire RMPM cost is a pass-through.
So this KNS ShoeTech acquisition that we have done and the investment of 100 crores that we have decided to put into shoe manufacturing, how much of that would be towards the shared manufacturing?
The entire shoe business actually is going to be shared manufacturing, Priyank. That's the model that the shoe industry follows. We believe that there will be some changes in the working of the shoe industry in the next couple of years. You would have seen some press reports of certain Taiwanese manufacturers of Nike, etc., beginning to set up shop in India. These guys are exclusive manufacturers for Nike, and we believe that that precedent will change the business models for a lot of the Indian existing contract manufacturers as well. But at the current stage, 100% of the business is that of shared manufacturing.
Okay, and then if you can help me further, since we are discussing on this topic of shared manufacturing, how does it work really? Is it that the OEM partner is also part of the same manufacturing facility and hence all the day one IRR is kind of a capped and on the upper side?
No, actually, Priyank, it's exactly the opposite. In case of shared manufacturing, since we do not have any kind of a take-or-pay contract with any of our principals, they have the flexibility of walking in or walking out of the facility at any given point of time. As a result, there is no cap on the IRR. The cap is defined completely by operating leverage. If we can get into a situation where our assets are sweated better, if we have a bigger order book, we will get better IRRs. On the other hand, you could have a possibility where we might end up making losses if all the customers suddenly decide to walk away. Just for the benefit of people who not followed our company earlier, we went through a similar phase with our beverage unit, which we acquired in Mysuru, where it was a shared manufacturing facility. And because of COVID, most of our clients were able to walk away from their commitments to the facility because it was shared manufacturing and we suffered losses for a couple of years. Right? So as far as ROI, IRR of this facility is concerned, it can be negative or it can be quite high as well. Much higher than the dedicated manufacturing.
Got it. Sorry, if I can squeeze in one last question. In the same model, what gives us the confidence, since we have not been, we have not invested so high amount earlier in our whole of the manufacturing block of 1,000 crores. What gives us that confidence to take a model which is slightly more volatile versus a non-shoe manufacturing model which is with the pass-through? So if you can help me on that, thank you.
Sure, Priyank. So couple of things, right? So first is I'll talk to you about the shoe business in a second, but let me just also explain, and I think it's a good opportunity for me to try and explain the strategy of the company to the wider audience as well. That we are trying to change the risk profile of the company. What we are trying to do is we are trying to broaden our customer base. You know that we've tied up with a new age brand as far as a dedicated factory for ice cream is concerned, which is contrary to what we've been doing so far, where we've been working with large multinational companies as far as dedicated manufacturing is concerned. And also in terms of this investment that we're doing in shoes, what we're trying to do is we are also trying to see if we can change our risk-return trade-off as far as our model is concerned. What gives us the confidence is exactly what I referred to in my opening remark. Given that we have a 1,000 crore asset block now, which out of that nearly 80 to 85% of that gross block is on a take-or-pay basis, which means we have confirmed revenues, and we have visibility in terms of the cash flow from most of these assets, we have some amount of confidence that our risk appetite can be increased. And then, of course, we raised the money in terms of the equity, which was supposed to be anyways growth capital. Both of these combined is giving us, from an overall perspective as a company, giving us some more confidence that we can increase our risk profile. Now, coming to the shoe business specifically, as far as the shoe business is concerned, the company and I specifically have been talking about it for the last few quarters. We have had experience with shoes since 2016 when we acquired the shoe business of erstwhile Ponds Export Limited, which was part of Hindustan Unilever. Unfortunately for us, the market for shoes, the leather shoes, stagnated. And Europe and the US also went through their own cycles with COVID and post-COVID inflation in those countries. So as a result, while we took over the shoe business in 2016-17, we actually have not been able to grow that business. This opportunity came in where, for one, we saw the shift in terms of the market from leather shoes to sports shoes and sneakers. We also saw the shift in terms of the global situation where a large part of the business which was being made in China moved to Vietnam, Bangladesh, etc., and is now beginning to come to India. Again, there you would have read articles on the investments being made by Fangte, Shoetown, Phoenix, Kothari JV in Chennai, etc. I think all put together, these guys have announced an investment of close to 3,000 odd crores in the summit which was held in Tamil Nadu recently. So which means substantial money is being invested in this sector. Coming to us specifically, so we like the sector obviously because of the growth potential coming to us. We do believe that our learnings of contract manufacturing, of having done contract manufacturing across product categories, can be brought into the shoe business as well. In addition to that, for the domestic market, we are also able to offer a distributed manufacturing strategy for some of our customers. To illustrate, for Bata, we have set up a facility in the west. In Mumbai, we've set up another facility in the south, in Tindivanam, Chennai, and we are able to produce products for them which are sold locally. All of this put together gives us the confidence, and then of course there's Ganesh, right? I mean, a lot of our confidence rests on Ganesh's ability to manage the supply chain, and the shoe supply chain is as complicated as it gets. So all of this put together gives us the confidence that we should be able to succeed. Let's see what happens in a year from now.
Perfect. That's great. Thanks for elaborating it. I'll come back in the queue if I have any questions.
Thank you. Before we move to the next question, a reminder to the participant, anyone who wishes to ask a question may press star and 1. Next question is from the line of Pritesh Chheda from Lucky Investments. Please proceed.
Yeah, hello, sir. Sir, all these investments which you talked about, the ice cream plant 100 crores, the Baddi 128 crores, the shoe business in excess of 130 crores. So these three areas, what kind of incremental revenue are you looking at and in what time period? And if I missed anything, because I think the KNS acquisition was at 31 crore Haryana, and are you investing another 100 crores in it, or that 100 is the separate acquisition which you talked about? So if you could just clear that also.
So hi Pritesh. So hello, yes, sir. You are correct that we are investing 100 crores in ice cream plant in North. We are investing another in shoe business. Total we have already invested 35 crores, and we will be investing another 100 crores in this line. We have also invested in the new juice line in Guwahati, right? And we have invested that was around 25 crores. And and we are investing. We have invested in Baddi 128, as you correctly said. So Baddi and the half of the 35 crores of the shoe business is already done, which we talked about that it will take us another quarter or so to integrate it into our system. The beverage facility will start commercial production by the third week of this month. Say you can say by this month we will start commercial production of the juices facility in East, and the ice cream facility will, as Samir has in his opening remarks told, that it will be into Q3, Q4 of this year of FY25. We will start manufacturing in there.
Yes, sir, I know the timelines. I want to know these whole investments now of 125 plus 128, 250 plus 130, so close to 375, 400 crores. In ice cream plant, beverage plant, OTC, pharma, and the shoe 130. This 400 crore investment translates into what kind of revenues?
Pritesh, obviously, what we can give you is a very, very top-line number, which is what we mentioned in our opening remarks as well. I think Mayank mentioned that in his opening remarks, that we are quite confident that we should be able to get to a 4,000 crore turnover by FY25. And that's a number which, if you ask us, we've been talking about for, I think, more than a year and some, maybe I think as much as 2 years. And I think we are well on track to do that. As and when we are able to give you some more details in terms of the top lines, etc., we'll update you. But Pritesh, let me just again give the same caveat. I would urge you not to look at top line as the only metric for evaluating our company. And I'll give you a specific example about the project that you've just spoken about. The project which we are setting up in Assam, Guwahati, which is for Dabur, is actually going to be on a job work basis, which basically means that Dabur will supply the raw material, packing material, and we will be paid only the conversion cost. So if you look at it from an asset turn perspective, we will be generating very, very low asset turns in that factory because we will be billing only the conversion cost. So I would urge you not to look at it as a revenue. We do give revenue targets because unfortunately that's the only way to convey to you the growth potential. But for sophisticated financial analysts like you, I would urge you to look at our gross block numbers, look at our ROE numbers, and evaluate it that way.
Okay. So, sir, let's put it this way. This 400 crores investment that we're talking about, at what ROIC? So your original ROIC that I see in the business has been about anywhere from 18 to 20%. For all the 1,000 crore that you invested in the HPC so far. So at what ROIC these investments are, and when will you hit the peak ROIC in this 400 crores investment?
Okay, I'm going to restrict the discussion to the ROEs, which is, I think...
No problem, ROE, no problem, yeah.
Yeah, 20-21% return on equity. I think in our previous call, Mayank has mentioned that we should be able to sustain that on a regular basis for most of our businesses. The shoe business here is going to be the trump or the joker, depending on what you say. Because if we are able to successfully integrate the business and ramp it up, the ROE expectation for the shoe business is much higher. And the reason it is much higher is because it's a predominantly labor-intensive business, and as a result, the total amount of investment in the shoe business is much lower as compared to, let's say, a facility like ice cream. And having said that, it comes with the disadvantage of having a very high operating leverage as well, because it's a shared manufacturing facility and we do not have any take-or-pay customers. So from that perspective, it could end up being the trump card which sweetens our ROE in the next few years, or it could actually be the joker which actually ends up making losses and pulls down our ROE as a company.
When do these investments become operational full swing? Is it 25 or is it 26? Because some plant of yours was quarter 3 FY25, the ice cream is quarter 3 FY20, that's why. So is it FY26 where we see the better utilizations of these investments?
Other than the ice cream factory, I think all of that should ramp up within this financial year itself. The ice cream facility, like I mentioned, I think I mentioned in my opening remarks, that we will have a partial ramp up within this financial year, but given the seasonality of the business, it will probably ramp up to its whole capacity only in the Q4, which is the summer season. I think Mayank referred to that. Maybe Ganesh.
And the last question is on the existing HPC business, which is a 2,600 crore that we see on that 1,000 crore gross block. So now here this business should largely grow at the FMCG rates, or do you have more opportunities within the overall the HPC space where you can look at more sourcing deals and grow faster than the FMCG market growth rate?
So, Pritesh, let me just step back for a second and tell you. So, it's not only HPC, right? I mean, this includes foods for us.
Okay, HPC and foods.
And the way we define FMCG so frankly, we are product agnostic, right? As a company, we really don't care what we are manufacturing. What we look at is the commercial construct of our agreement with the customer, which is either it's a dedicated factory or a shared manufacturing facility, or we're doing private label for some retailer or a D2C brand. Within that, it could be home care, it could be personal care, it could be color cosmetics, it could be foods, it could be beverages, and more recently, it could be OTC pharma or shoes. Now that's just setting things correct. In terms of our growth potential, I think the HPC stroke FMCG sector, the way we define FMCG, which includes home, personal care, and food, I think the potential is still quite large. If you look at it, and there's no specific printed data set, but if you look at overall FMCG market and you look at the COGS of that market, you'll find out that the total market for contract manufacturing could be anything between 50,000 crores to 100,000 crores. Within that space, we are barely 2,000, 3,000 crores, and we are probably amongst the largest and the most diversified contract manufacturer in the country. So as a runway for even our mainstay FMCG business is concerned, I can rattle off at least 3 or 4 names of large FMCG companies in the country who are currently not our clients, and as a result, we have zero wallet share from them, and most of those companies have turnovers or at least COGS budgets of more than 5,000-10,000 crores. So from that perspective, I think the potential even in the FMCG sector is quite high. It's been a little tough or it's been a little slow in the FMCG business because there's been no volume growth, and as a result, a lot of the projects that we've discussed or have been in the pipeline continue to be in the pipeline because our principals, our customers are not seeing the need for extra capacity coming in. Now, the flip side of that, of course, is that in a situation where they're not seeing volume growth, they'll be looking more at contract manufacturing and outsourcing because obviously they'll also look at trying to better their margins. So from that perspective, we do believe that FMCG still holds a very large potential for us. We're not in any way giving up on it. Our ice cream business that we signed off is just another way of increasing our depth in that. And we'll continue to do that.
Okay. Your existing block on your balance sheet, is it fully utilized? So you need to sign more assets and more deals in this FMCG stroke, HPC, whatever the way you define, for growth, or there is some scope within the block to grow? Hello?
Sir, we have lost the connection for the management. Please stay connected while we reconnect them to the call.
Okay.
Ladies and gentlemen, thank you for patiently holding. We have the line for the management reconnected.
Hi, Pritesh, are you online?
Yes, he is connected.
Okay. So sorry for the disconnection, guys. Sorry. So Pritesh, we were talking that some of the gross block which is in is not.
So I was asking that is there on the balance sheet. Do you have, is it fully utilized? And hence your growth is then incrementally dependent on new deals that you sign, or you have spare capacity within the existing block based on your arrangements to grow?
So one caveat in this, that in that 1100 crores of gross block, around 1100 crores gross block which we are talking about, around 130 crores is for Baddi, which is just signed up and it will require some time for them to ramp it up, and some CWIP of 50 crores in various plans. So 200 crores of this 1100 crores is still to be ramped up or to be commercialized. Other than that, more or less all the plants are running okay. There is some seasonality in some of the plants like ice cream and beverages, where it is in this quarter, seasonality has would drop down our turnover in this quarter. Rest of it is utilized.
But Pritesh, I might take this opportunity to emphasize again that in case of dedicated manufacturing, where we have a take-or-pay contract, we do not have any operating leverage. So even when revenues go up or the capacity utilization becomes better in those factories, it actually will not make any difference to our bottom line. I hope I've been able to clarify that. Yeah.
Perfect. Lastly, on your shoe ponds export, which used to be once upon a time your business, there the ROCEs were in excess of 30% actually. So those are the ROCEs one can look at in the ROEs, the way you mentioned. Those are the ROEs that one should look at in the shoe investment.
If everything goes right, Pritesh, yeah.
And those were like a double-digit margin business at that point in time.
So again, I'm hesitant to talk about margins. Also hesitant to draw an exact comparison between the leather business and the shoe manufacturing business.
Sir, your voice is cracking, sir. Just a moment.
No?
Sir, your voice is cracking.
Okay, I can hear you loud and clear.
Yes, this is better. You can go ahead, please.
Okay. So, Pritesh, hesitant to talk about a direct comparison between the leather and the sports shoe business for a couple of reasons. The sports shoe business is slightly more technical and requires more capital investment, especially in terms of soles, etc. And having said that, yes, we are definitely expecting it to have better ROE profile than our existing business. But please bear in mind that since these are not dedicated facilities, we still have that operating leverage working either for us or against us.
Okay. Thank you, sir.
Thank you. Next question is from the line of Akhil Parekh from BNK Securities. Please proceed.
Hi, thanks for the opportunity. My first question is on the fundraise, right? We raised 400 crore and we mentioned that of that 100 crore will be in the sports shoe business. Could you please give a detailed bifurcation of how we have expected to utilize this 400 crore, because we'll have our internal approvals as well for next 2 years. If we have some visibility around that complete utilization of 400 crore.
So hi Akhil, in some of the earlier calls we have given the target that we will, when our gross block was around 800-900 crores, we have given the target that we will double our gross block in next 2 years. This will involve this 400 crores of equity.
Sorry to interrupt, sir. Your voice is cracking again. Sir, I'll disconnect you and reconnect. Ladies and gentlemen, please stay connected while we reconnect to the management. Thank you. Ladies and gentlemen, thank you for patiently holding. The line for the management is reconnected. Over to you, sir.
Hi, Akhil. So in the nutshell, what we were saying that we will invest around 800-900 crores in gross block in next 2 years. Some of it is already been in public domain, the ice cream factory or the shoe business or Baddies and all those things. And the fundraise which we have done, coupled with the debt which we take and also the internal accruals, will fund this growth for next 2 years. That is the reason we have opted for the warrant structure rather than taking the money in one shot, so that we can time the investment better.
Okay. No, that clarity I got it. Like from 900 crore, we are aspiring to have 1800 crore of gross block. So with that, so it's a 900 crore of incremental growth in gross block, right? So of which you are saying 130 crore will be in the sports shoe, roughly 130 in Baddi, and another 100 crore in ice cream. So that total sums up at around 350-360 crore. Right, so remaining 600 crore is still. Is it fair to assume right now we do not have visibility and or we have some plans?
We have Akhil, that you have been following the company. You know that at certain point we have many things in pipeline, right? So you are right that these are the signed contracts, but that there are many things which is in pipeline. That is why we told that this 900 crores will be in 2 years' time. So it requires another 3-4 months of negotiation, and then to sign up the contract, it requires another 3-4 months, and then investing for another 6 months. So that is why we are saying that we will utilize the entire fund in 2 years' time by FY26.
Okay. So that's clear enough. So by FY26, we'll have 1800 crore of a gross block, approximately.
Akhil, that's the plan, and to answer your question specifically, we obviously are not in a position to discuss anything specific. We continue to work hard, and we hope that we'll be able to convert some of the things that we have in our pipeline into real businesses, which we can then come back and inform you about.
Sure, fair enough. Second question is on the ROE part, right? I mean, we have been fairly consistent in terms of ROE at 18 to 22% because of dedicated manufacturing business that we have. So one is, if I look at inflection point in terms of ROE improvement going forward, right? One is shoe business. If all goes well, you are saying we can see an improvement in ROE. And second, because of this Baddi unit, should we expect ROE improvement as well, or will the ROEs be in the same range as 18 to 20% for the Baddi unit?
So the ROEs should improve for sure. The Baddi unit, given that it's a regulated site, given that we're getting into a new sector, which is OTC pharma, we expect that it should deliver better ROEs. Purely from the perspective that the risk profile of a pharma OTC factory is frankly completely different than, let's say, manufacturing a toilet cleaner or a floor cleaner. So from that perspective, we tend to benchmark our ROEs against the kind of risk that we take. And in case of OTC pharma, we obviously expect to get better ROEs. And similarly, I've mentioned this in my previous call as well, where we are also trying to diversify our client base. We're going after some of the newer age brands, etc., which we also believe should help in terms of the ROE improvement. So 20-21% is the sustainable ROE that we currently have. Depending on how the shoe business turns out and how the integration of the Baddi factory turns out, we definitely hope to improve that.
Sure. And this Baddi unit is a shared facility, right?
It's actually what we call an anchor tenant model, where a large capacity of our factory is already booked, where we, as you're aware, we acquired this facility from Reckitt Benckiser, and Reckitt Benckiser has given us a take-or-pay for a large part of our capacity. The balance capacity, we are allowed to offer it to competing products and competing brands.
Okay, sure. And lastly, on the two businesses, right? One, we acquired Scholl's India. couple of years back. We have not heard lately anything from you in terms of how that business is doing and how the utilization rates are there at that facility. And second, on the co-packing for the MNC carbonated drinks company.
Sure. So as far as the Shawl facility is concerned, let me just step back and refresh the transaction details for the benefit of the larger audience. We acquired a facility in Chennai, which was earlier owned by RB Shawl. RB Shawl, which is Reckitt Benckiser Shawl, sold the brand Dr. Shawl to a PE fund based out of Boston. And as a result, this facility became redundant. We acquired that facility where we continue to supply to the PE fund now, the owner of Shawl Wellness Company. Having said that, the model that we followed in that facility was that it was supposed to be an anchor tenant model where we could manufacture for other products as well as other brands. I'm happy to inform you that we've signed on one more customer, a UK-based customer, for manufacturing similar products there. Maybe the reason you didn't hear about it, Akhil, is because if you look at the overall business, it's a very, very small part of the business. Having said that, we also are making some investments there to diversify into new product ranges, and maybe in the coming quarter, we'll be able to update you on what exactly is happening there.
Okay. And on the co-packing business for the MNC carbonated drinks company?
So that we are hoping that the summer gods will be fine. Like Ganesh was saying, we are ready. We've ramped up the capacity, etc. And we will find out in the next month or so how the beverage market is going to be doing. And that's how we'll come to know. As far as the contract is concerned, we are definitely in place. We are now manufacturing for Paperboat, we are manufacturing for Coke, we are manufacturing for Tata Consumer in that facility.
So in case of Coke, we will be supplying to their bottler, right? Is that understanding correct?
Our contract is with Hindustan Coca-Cola Beverages.
Sure. Okay.
Yeah.
Okay. All right. That's all from my side, and best luck for coming quarters.
Thank you so much.
Thank you.
Yusuf, before we move on to the next question,
yes, sir.
I finally solved the mystery of the breaking up sound. So my colleague, Mr. Vimal Solanki, has just joined in the room, and it was his bones that were cracking. Yusuf, go ahead.
Next question is from the line of Priyank Cheda from Vallum Capital. Please proceed.
So just I wanted a clarification on the usage of 400 crores, out of which 125 would be used for Baddi, 125 or 130 is what we have dedicated towards shoe as of now as a utilization, and some of part was towards even the WIP of ice cream facility, right? These are the three broad utilizations that we have fixed as of now, balance which we would be calling out as and when we have. Yeah. I hope correct me if I'm wrong on this.
Priyank, first of all, that this is in the warrant structure, so we have received only 25% of it is 100 crores. The Baddi transaction we have closed before this. So as of now, we are utilizing this money to fund our the shoe takeovers, and some part of it will go in the ice cream capex startup. And as and when the new project come in, and we will call the money as required.
Got it. Perfect. And a question on the Baddi, if I missed out, by when do we expect to go to an optimal level of utilization? So given an anchor tenant model, so the part of the utilization would be booked by the Reckitt, but balance is what I'm looking towards. What is the time frame that we should think of?
So there are a couple of moving parts there, Priyank. First of all, it's a regulated site. So even for the anchor tenant, for us to be able to normalize production, we believe that it will take anything between 3 to 6 months. And given that it's a pharmaceutical product, the gestation period for getting a new customer is just about a year or so. Our contract with our anchor tenant gives us the flexibility of a year to develop new customers. So for ramping up the capacity completely, I would say it would take about a year or so to be able to reach where the anchor tenant has guaranteed the capacity. I think it should take between 3 to 6 months.
Perfect. And just on a broader strategic question on to how HFL is moving towards it. So we have seen larger investments like Baddi, and we have also seen a smaller investments like Mysore, where we have just invested 8-10 crores despite being a big land parcel over there. So now what I'm trying to ask is the theme which is of consolidating contract manufacturing to a larger players. Should we look towards a very large investment? What kind of these investments? Would it be only into shoe? Are we open towards FMCG and foods? Is what I'm looking forward for.
Sure. So Priyank, couple of things are happening, right? One is there's some amount of greenfield projects which are coming up because of the decentralization of manufacturing and the redrawing of the manufacturing footprint by our customers. When it comes to those kind of decisions, the factories that we are being set up are large factories. They have a long-term view on it. And because they fit the geographical requirements of our customers, they tend to be much, much more specific. The second opportunity which is also coming in is that of consolidation. Because of social compliances, because of a bunch of issues arising primarily after COVID and then also getting exaggerated recently because of the slowdown in the FMCG volumes in the market. We are also getting some interesting opportunities for consolidation. As far as those consolidation is concerned, those are existing contract manufacturers who are either not able to scale up or are not able to sustain the new requirements of our customers. Those transactions, frankly, could be smaller. Those transactions, generally, we try to look at a stressed asset or a distressed value. And from that perspective, we will continue to engage and look at smaller transactions as well. So I don't have a clear answer for you. We'll basically do both. We will definitely be doing large projects where we will write check sizes of 100 crore plus. But we also will look at smaller transactions where the check sizes could be as low as 15-20 crores.
And I got that. And on the shoe as a category, we have some experience. We are investing more. Should we look that first? We will try to spread the asset and the investment that we are doing it today, or we would look towards adding more such assets and then take the bigger gross block into play.
So, Priyank, obviously we okay. So first of all, we're buying we have bought an existing running company, and the negotiations that we are doing is also for a running operation. And as a result, we will not be starting off from zero. We have certain client relationships. We have certain businesses which are coming into fold because of the acquisition. Having said that, the acquisition, of course, is going to take some time in terms of the integration, in terms of us being able to get it to a level of efficiency where we are happy with it. And that's the journey that's going to take maybe a quarter or so that we've talked about. As far as the business per se is concerned, we'll hit the ground running. That's the advantage of looking at M&A as opposed to a greenfield project, that we don't have the gestation period that would normally be associated with a greenfield project. So in case of an M&A, we are getting the relationships, we're getting the business, and pretty much from the day the closing date or the record date, the revenue starts coming in. So that's one part of your question.
Got it. All right. Thanks a lot.
Sure, Priyank.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to Mr. Vimal Solanki, Head Corporate Communication and Emerging Business, for the closing comments.
Thank you, Yusuf.
So we at Hindustan Foods are committed towards ESG and have undertaken various sustainability initiatives like integration of solar power plants and rainwater harvesting systems at our new plants, adoption of briquette boilers to replace traditional coal-fired ones, transition to cleaner fuel to reduce carbon emissions and promotion of cleaner energy alternatives, embracing smart lighting and air conditioning systems, digital payments and signature methods, replacing vapor lamps with LEDs in operations to conserve power consumption and striving to minimize paper use, thereby reducing energy consumption and paper waste. Collaborating with our principals to adopt eco-friendly and minimal product packaging practices, promoting sustainable supply chains, action towards segregation and disposal of plastic waste in line with regulations and reducing environmental impact. Also prioritizing the employment of local labor in our factories, contributing to the economic development of rural and semi-urban areas where our facilities are located. And finally, enforcing the mandatory preservation of trees and plants in and around our factories, fostering a greener environment and enhancing biodiversity. With this, I take this opportunity to thank everyone for joining this call. I hope we have been able to address all your queries. For any further information, kindly get in touch with us or SGA, our investor relation advisors. Since we are approaching 14th February, what do I say? Lots of love. Thank you.
Thank you very much. On behalf of Hindustan Foods Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.